Okay, so that was a good entry point because nobody agreed, but it was unstoppable. That's what I say. The best investment is something everybody needs. Nobody can stop, but nobody understands. Right? That's what Apple was. That was what Facebook was. That was what Amazon was in 2008, 2010.
So the amount that's pretty liquid is actually not that big. And so when a significant amount of capital wants to come in, that can move the price very quickly. And I track a couple things. I mean, obviously the ETF news is probably being constructive towards it, the upcoming halving. But another thing I track is that Bitcoin price correlates very heavily with global liquidity, and it's just been a long bear market. A lot of the coins have rotated towards very strong hands, and so it only takes a small amount of new demand to move the price pretty disproportionately.
I think that anybody has some capital. Anybody that has capital to invest, they should take a minimum of a 10-year time horizon. And I really think a 100-year time horizon is the right time horizon to get you to think rationally. So now the question is just, how do you want to have your portfolio allocated? Some mixture of scarce desirable assets. I've already laid out the case for why Bitcoin, I think, is the most scarce, most desirable asset. And if you're not going to hold Bitcoin as the scarce desirable asset, then I think you have to own something else. Like I respect the royal family of Japan or Britain for holding real estate in the middle of their respective cities, right? Tokyo and London. Have a scarce desirable asset you're going to hold forever. I don't think trading is a good idea for anybody other than a professional. So if you look, maybe 0.1% of the people, if you're a professional with proprietary models and proprietary equipment and proprietary access, you might be able to trade. But 99% of people cannot trade successfully. I don't think I can trade successfully. And if you look at the statistics, if you remove 1% of the trading days, the 1% most profitable trading days from your activity, there is no return. Like you would get a 7 or 8% return per year on stock portfolios if you just hold them for 100 years. But if you take out 2 days a year or 3 days a year, you actually get a negative return if you take out the 3 best days. So if you don't guess the 3 best days, if you're not long the 3 best days out of 365, there is no return. So statistically, 99% of the time, someone's telling you to trade, but you shouldn't. And 1% of the time, everything moves, but generally people can't predict when that 1% is. It'll happen when you least expect it. So trading is, in my opinion, a fool's errand. I think it's a very dangerous thing. And most people are going to squander their capital because they're going to try to outsmart the market. And I think stock picking is equally challenging. I just laid out there's 7,000 publicly traded companies. If you take out the 7 best ones, there is no return. 99.9% of the companies can't beat inflation. Okay, so we know which ones can, like Apple, Google. But the question is, did you know that 10 years ago, the reason I was able to buy 17,000 Bitcoin is because I was able to pick Google and Apple and Amazon in 2010 and hold it for a decade with a lot of money, right? But on the other hand, if you picked Amazon in the summer of 2020, you didn't make any money. You know what happened in the summer of 2020? Like, I tell you a real story. It's like, when my 3 or 4 year old niece, when she said to me, I like the Big Apple, this was like 2010 or 2008. I said, wow, it's a young girl and she's saying she likes Apple. This means Apple's a big deal. We should load up on the stock. And that was when 98% of the world, or 99% of the world, didn't agree, and they thought it was a stupid idea, and Apple was valued at like 8 times cash flow. and you could have bought it 100x from there or something, just ridiculous. But I thought, yeah, this is a good idea. And I wrote this book, The Mobile Wave, and I actually tell the story in the first chapter of The Mobile Wave about how, my young niece thought Apple was amazing. She called the Big Apple, that was the iPad. And I thought the Big Apple had been New York City, and now the Big Apple is iPad, and this is a big change in wealth. Okay, so that was a good entry point because nobody agreed, but it was unstoppable. That's what I say. The best investment is something everybody needs, nobody can stop, but nobody understands. Right? That's what Apple was. That was what Facebook was. That was what Amazon was in 2008, 2010. Now, in the summer of 2020, you know what my niece told me? She said, I'm buying Amazon stock. Everybody knows it's a winner because everybody's in lockdown and they're all basically ordering, like they're ordering their food in, they're ordering their groceries in. Okay, so everybody knows, every 20-something investor, every Gen Z person knows that they should buy those stocks. Well, it didn't work, right? Because everybody knew it, everybody agreed, everybody needed it, but everybody understood they needed it. And so, in fact, what you've got 36 months later is you have all the logistics challenges, the supply chain challenges, the labor challenges, the inflation challenges, the manufacturing challenges, and everybody needs it. And everybody understands it. But, if the criteria was, do you need it and do you understand it? The richest people in the world would be investors in water companies and electricity companies because everybody in New York City needs water and power. But name me one billionaire in the 21st century that's a water billionaire or electricity billionaire, And the reason why is because everybody understands it. And once everybody understands it, it's getting regulated. And once it gets regulated, it's not an unregulated monopoly. It's a regulated monopoly. They're not going to raise their prices. And people aren't going to, they pay less for their electricity or whatever than they're going to pay for their whatever favorite streaming video thing that's the fad. So, I think that when people, they talk about, the recession's coming or whatever, they're attempting to outstock pick the market. They're attempting to outtrade the market. They're feeding on your gloom and doom. What do they want you to do? Sell your scarce desirable assets and buy the dollar? They want you to go short. Are you going to sell London real estate to buy the dollar? No. Or they want you to sell your desirable assets and give the money to them. It's like, I wouldn't trust anybody that basically comes to me with doom and gloom and fear and says, whatever your idea is going to zero, so give me your money. You see, the difference is I'm not asking for your money. I'm telling you, keep it yourself. Just, don't blow it. So if all these things happen, then the governments of the world are going to print more money to solve the problem. If there's war, if there's recession, they're going to print more money and it'll drive up the value of scarce desirable assets. If none of these things happen, they're still going to print more money, right? In good years, they're going to inflate the currency supplies. In bad years, they're going to inflate the currency supply more. And, if you look back for the past 100 years, if you could have bought an acre of real estate in New York or London or Tokyo, at what point would you have sold it? Never. There would have been booms and busts and crises and recessions and whatever. But, the only winning strategy is you hold the most desirable asset for the longest period of time and you let everybody else panic sell. And I think that's the case with Bitcoin right now. I mean, you hold on to it.
Basically, the reverse repo facility, the way to think of that is that basically represents excess demand for T-bills. And so what the Fed does not want is for there be so much demand for T-bills that it pushes T-bill yields below the lower end of their target short-term interest rates. And so they have this release valve where money can instead go into a reverse repo facility and get yields that are similar to T-bills. They hold it at that level to make sure that basically there's no reason for T-bills to go below the reverse repo facility rate by any significant degree. And that's part of their kind of tightening process. And when the Treasury issues a ton of T-bills, that money can come out of reverse repo and into T-bill. So reverse repo is one of those things where, in a healthy market environment, there really shouldn't even be a reverse repo facility. Right now, it's just kind of this excess pocket of liquidity that was built up during the stimulus, and now it's kind of coming back out. And so it's kind of counteracting the Fed QT. The reason it's relevant is because after it runs out, um, if the Fed continues doing quantitative tightening, that'll be start to come out of bank reserves. It'll start to kind of kind of reduce liquidity in the core banking system, and therefore increase the odds of some sort of liquidity accident. Which, if it shows up in the Treasury market, you'd probably have the Fed come in and stop QT. A similar thing happened back in 2019 with the repo rate spike. It wasn't some gigantic event for normal people. I mean, basically, it's one of those like quiet crises that most people don't know of. But if anyone who was like following macro or banking at the time was like watching this with interest, because you had kind of an interbank overnight lending rate just completely blow out, and the Federal Reserve, in addition to addressing that market, had to come in and start buying treasuries again. Because that was kind of the core problem. There was a treasury oversupply problem. And going back to the prior point of, soft landing versus hard landing, I've been using the term emerging market landing, because when you look at like recessions in emerging markets, they look pretty different than we see in developed countries. You know, um, you have an environment where you have kind of recession-like conditions, but asset prices in local currency terms are still doing okay, because the local currency is pretty running, often very large deficits, is often inflationary. Um, and so you get these weird dichotomies where it's like a hot recession, right? It's like an inflationary recession, a stagflationary recession. And so asset prices and things like that are not doing great in, dollar terms or gold terms, or things like that, but they're doing okay in local currency terms because local currency is having a problem too. And those types of recessions only come up rarely in developed countries. We had it back in the 70s. We arguably have it right now, and we had it back in like the 40s. And those are kind of the instances where this pops up. We also see there's a very big divergence between fiscal and monetary. So monetary, like, Federal Reserve, Jerome Powell, they're trying to be relatively tight. They're trying to hold rates at a high level. They're trying to reduce their balance sheet. It's largely coming out of reverse repo. On the other hand, the government, Congress, president, and all these groups, they're running very, very large fiscal deficits. And it's not even just now, it's accumulated from decades past. So a lot of it is just interest expense is completely blowing out, ironically, because the Federal Reserve is trying to tighten. And fiscal deficits, all else being equal, are stimulatory and inflationary. So we have this kind of weird dichotomy, which is that if you're primarily reliant on short-term financing or a lot of financing, you're probably in trouble. You're already probably in a recession, or at least your industry is. And if you're not, and if you're on the right side of deficits, if you're the military-industrial complex, if you're kind of in your own, if you're on the right side of all this interest expense, then you're doing okay. And so I think that's why the economy is kind of feeling very odd to people, because it's we have a larger gap than normal between fiscal policy and monetary policy, and so that results in kind of very bifurcated economy and very bifurcated markets.